Let's talk about Unite Group, the UK's student housing giant, a company that's quietly shaping the future of where students live, learn, and connect. Not only is Unite a real estate powerhouse, but it's also a company you can actually invest in, making it a unique player in the property market. They own and manage massive portfolios in the UK's top university towns, with properties that stretch across bustling cities and vibrant student communities. Every year, they provide homes for tens of thousands of students, offering more than just a place to sleep. These are spaces designed for growth, friendship, and opportunity. This isn't just about dorm rooms, it's about building thriving communities, supporting student life, and dominating a market that's only getting bigger. Here's the headline. Unite just announced a massive $100 million share buyback, a move that's turning heads in the investment world. That's not pocket change. It's a bold signal from management that they believe their stock is undervalued and see real potential for future growth. When insiders bet big on their own company, it's a story worth paying attention to, because it often means they know something the market doesn't. We'll break down what this buyback means for Unite Group, for the student housing sector, and for investors looking for smart opportunities. We'll explore how this move connects to their business strategy and what it signals about their confidence in the future. And most importantly, we'll look at why this matters for investors, whether you're already in the market or just starting out. This is more than a financial move. It's a statement of confidence, a strategic play, and a glimpse into how big companies make bold decisions. Whether you're a seasoned investor or just curious about how big money moves shape the business world, this is the kind of insight that can really pay off. Let's dive in and see what's behind Unite Group's big decision. So, what's a share buyback? It's a term you might hear tossed around in the news or in financial reports, but what does it actually mean for a company and its investors? Imagine a company as a pizza, and each share is a slice. The more slices there are, the smaller each one is for every person at the table. When the company buys back slices, there are fewer pieces left for everyone else, making each remaining slice bigger. In other words, your share of the company just got a little larger without you having to buy more. Companies do this to show confidence. Management believes the stock is cheap and worth investing in. It's a public signal that they trust their own business and its future prospects. Fewer shares mean each one is more valuable, and key metrics like earnings per share look better. This can attract new investors and boost the company's stock price over time. It's also a way to return cash to shareholders without paying a dividend, often more tax efficient. Shareholders benefit from the increased value of their shares, and sometimes even from a rising stock price. Instead of letting cash sit idle or making risky acquisitions, they're investing in themselves. This can be a smart move, especially if there aren't better opportunities for growth. Buybacks signal discipline and a focus on shareholder value. They show that the company is thinking carefully about how to use its resources for the greatest benefit. So next time you hear share buyback, think confidence, scarcity, and a bigger piece of the pie for investors. It's a strategy that can reward those who stick around. That's exactly what Unite Group is doing right now, making moves to strengthen their position and reward shareholders. It's a financial power play, one that can reshape the company's future and its value in the market. Let's see how they're pulling it off, and what it could mean for investors like you. Unite's $100 million buyback isn't just talk. It's a real funded plan, backed by decisive action from the company's leadership. This isn't a vague promise or a headline-grabbing announcement. It's a concrete commitment, with the money already set aside and ready to be deployed. The money comes from surplus capital, freed up by deferring some new developments. By pausing certain projects, Unite has unlocked significant resources, allowing them to redirect funds toward initiatives that can deliver immediate value to shareholders. Instead of building more properties right now, they see better value in buying their own stock. This strategic pivot shows they're willing to adapt their approach when market conditions change, prioritizing what's best for the company and its investors. This shows financial discipline and a sharp focus on shareholder returns. It's about making every pound work harder, ensuring that capital is allocated where it can have the greatest impact. Management believes the market undervalues their business, and they're acting to close that gap. By buying back shares, they're sending a message that they have confidence in the company's long-term prospects. They're not taking on extra debt, they're using cash on hand. This approach keeps the balance sheet strong and avoids unnecessary financial risk, which is especially important in today's uncertain economic climate. This flexibility and confidence are hallmarks of a well-run company. It's a sign that management is both prudent and proactive, ready to seize opportunities as they arise. For investors, it's a clear sign. Management is committed to maximizing value. They're not just talking about growth, they're taking tangible steps to deliver it. They're not chasing growth for its own sake. They're making smart, strategic moves. Every decision is carefully weighed, with a focus on sustainable, long-term success. This buyback is a spotlight on Unite's belief in its own future. It's a bold move that demonstrates conviction and a willingness to back up words with action. It's a bullish signal you can't ignore. When a company puts its own money on the line, it's often a sign that better days are ahead. Let's look at the numbers behind that confidence and see what's driving this bold decision. A buyback only works if the business is solid, and Unite's 2025 earnings guidance backs it up. They've reaffirmed their forecast for the year, projecting adjusted earnings per share between 47.5 and 48.25 pence. That's a strong signal of stability and predictability in a shaky market. Management's confidence in their numbers is the foundation for this buyback. There's even a little bonus, a one-off management fee from a university joint venture added about a penny per share. Multiple income streams, not just rent, are boosting their position. This steady guidance, combined with the buyback, tells a compelling story. Unite isn't just saying we're fine, they're saying our stock is a great investment right now. The numbers prove it. Let's see how their recent performance supports this outlook. On to the latest results. Unite's latest trading update, solid and steady, just what investors want. No surprises, just consistent performance that enables bold moves like a $100 million buyback. Property values dipped slightly in Q4, USAF down 0.7%, LSAV down 1.4%, but both were up for the full year. The real story: strong rental growth offsetting market pressures from higher interest rates. Demand for student housing lets Unite raise rents, keeping property values resilient. This operational strength generates the cash and confidence for buybacks and steady guidance. The numbers show a robust business navigating economic headwinds with skill. Demand isn't going away, it's growing. That's the bedrock of Unite's strategy. Let's check how full their buildings really are. Occupancy is key. Occupancy rates are the heartbeat of Unite's business, and they're consistently high. Their target 93–96% full, year after year, thanks to relentless demand in top university cities. For the 2026-27 academic year, 64% of beds are already booked, just a touch behind last year. But management isn't worried. Booking timing varies, but the underlying demand is rock solid. There's a structural undersupply of student housing, giving Unite pricing power and confidence. Nearly 2/3 of next year's revenue is already locked in. This isn't guesswork, it's contracted income. That predictability is why Unite feels comfortable returning capital to shareholders. The money is coming in, year after year. Now, let's see how they're making the business even leaner. Unite just got leaner, cutting head office staff costs by 20% through a smart restructuring. It's tough, but it means more efficiency and a stronger bottom line. These savings can be reinvested, used to pay down debt, or returned to shareholders. Meanwhile, property values saw minor dips last quarter due to higher interest rates. A market-wide trend, not a Unite problem. But strong rental growth is offsetting those pressures, keeping the portfolio resilient. The full-year property values are still up, showing the strength of student housing as an asset class. Even in a tough environment, demand keeps values robust. This is disciplined management in action. efficiency, and resilience. 2 reasons Unite stands out. Let's look at what's next for the company. What's ahead? Unite's roadmap is all about discipline and smart capital management. In February, they'll release full-year results and fresh guidance for 2026. Expect more detail on earnings and strategy. A key part of their plan selling 300 to 400 million in properties each year to recycle capital. They sell non-core assets, unlock cash, and reinvest in new developments or upgrades. This keeps the portfolio fresh and maximizes returns. Recycled capital also funds dividends and buybacks, rewarding shareholders directly. It's a sustainable, forward-looking approach. Management isn't just reacting, they're executing a multi-year strategy. The combination of efficiency, capital recycling, and shareholder focus makes Unite a compelling story. The next results will add even more color. So, what does all this mean for you, the investor? One word: confidence. Unite's buyback, steady earnings, high bookings, and leaner operations all point to a company firing on all cylinders. Nearly 2/3 of next year's revenue is already booked, visibility most companies dream of. Management is recycling capital, optimizing the portfolio, and returning value to shareholders. The buyback is the ultimate vote of confidence, making each share more valuable. It's not a gamble. It's a calculated move based on real performance. Management's interests are aligned with yours. They want the stock price up too. Unite is navigating a complex market with skill and discipline. Structural undersupply, pricing power, and efficiency are all working in their favor. The signals from Unite's headquarters are flashing bright green. Do your homework, but this is a story of strength and strategy. Booyah!